Hello and welcome back to the Pesa Forever channel. It is January 2026, and if you have been following the financial news lately, you know that the conversation around digital assets has shifted dramatically. It feels like the market has moved from the experimental phase we saw in 2024 and 2025 into something completely different. Everywhere we look, the headlines are dominated by what analysts are calling the crypto ETF supercycle. It is no longer just about Bitcoin. The sheer volume of financial products flooding the US markets is unprecedented. But, as always, the big question for us sitting here in India is, how does this impact us? Can we participate, or is this strictly a global phenomenon? To help us untangle the regulations, the taxes, and the market mechanics, I am joined by our financial expert. Welcome back.
It is great to be here. You are absolutely right. 2026 is starting off with a level of institutional intensity we haven't seen before. We are witnessing a structural shift in how capital flows into digital assets. This super cycle isn't just marketing jargon. It describes a specific supply and demand dynamic. Following the SEC's decision to relax listing rules late last year, the US market has been inundated with new ETFs. We now have products for Ethereum, Solana, and even XRP. The data shows that these ETFs are currently absorbing over 100% of the new crypto supply entering the market. When you have major asset managers acquiring assets at that rate to back their funds, it creates a very distinct price support structure.
That supply absorption statistic is incredible. It sounds like the scarcity is being driven by these massive funds. Now, naturally, when Indian investors hear about this boom, the first instinct is to open their local demat accounts and search for these tickers. I tried this morning, searching for the popular US Bitcoin ETFs on my Indian trading app, and I found absolutely nothing. Why is that?
That is the reality of the current regulatory framework in India. The Reserve Bank of India, RBI, and the Securities and Exchange Board of India, SEBI, continue to maintain a cautious boundary between the domestic core banking system and the crypto ecosystem. As a result, these crypto ETFs are not listed on the National Stock Exchange or the Bombay Stock Exchange. They are strictly US domiciled securities. For an investor in India, this means these assets are invisible on local platforms. The only mechanism available to access these specific financial instruments is the Liberalized Remittance Scheme or LRS.
So the LRS route is the only bridge that involves remitting funds abroad to a US brokerage account, correct?
Precisely. The process involves using a global investment platform to open a US brokerage account. The investor then remits Indian rupees which are converted to US dollars, allowing them to purchase these ETFs on exchanges like Nasdaq or YNSE. It is identical to the process one would use to purchase shares of Apple or Microsoft from India.
It definitely adds a layer of complexity compared to simply buying a coin on a local crypto exchange. This brings us to the most debated topic in this space, taxation. One of the main talking points in 2026 is that the ETF route offers a tax arbitrage. Can you explain the technical difference between holding crypto directly versus holding it through a foreign ETF?
This is where the structure of the investment becomes critical. Under the Indian Income Tax Act, direct investments in virtual digital assets, meaning buying Bitcoin or Ethereum directly on an exchange, are subject to the specific VDA tax regime introduced a few years ago. That entails a flat 30% tax on gains, a 1% TDS on transactions, and crucially, no provision to set off losses against profits. However, a US-listed ETF is generally classified as a foreign equity asset.
So the underlying asset is crypto, but the wrapper is a foreign stock.
Correct. Because it is a security listed on a foreign stock exchange, it falls under the capital gains rules for foreign assets. If an investor holds a foreign equity asset for more than 24 months, it qualifies as a long-term capital asset. Under the prevailing tax rates in January 2026, long-term capital gains on foreign assets are typically taxed at 12.5%. When you compare 12.5% to the flat 30% levied on direct crypto, the difference is significant. Furthermore, the foreign equity classification typically allows for the setting off of capital losses against other capital gains, which is impossible with direct crypto trading in India.
That 17.5% difference is substantial for anyone with a long-term horizon. But we have to look at the downsides too. The LRS route isn't frictionless. There's the issue of tax collected at source or TCS. How does that factor into the liquidity equation?
The TCS rule is the primary friction point. Under the current LRS norms, any remittance exceeding rupees 7 lakh in a financial year attracts a 20% tax collected at source. This is not an additional tax, it's an advance tax that can be claimed as a refund when filing income tax returns. But it creates a cash flow impact. If an investor remits rupees 10 lakh, 2 lakh is deducted upfront and held by the government until the tax refund is processed the next year. This effectively locks up 20% of the deployable capital, reducing immediate market exposure. For transactions under 7 lakh, this doesn't apply, but for larger allocations, it's a liquidity constraint that must be calculated.
It effectively increases the capital requirement if you want to deploy a specific amount. Let's shift focus to the assets themselves. We're looking at a market in 2026 that seems very different from 2021 or 2022. Bitcoin, for instance, is it still behaving with that extreme volatility we used to see?
Market data from the last 12 months suggests a maturation. Bitcoin's volatility metrics have compressed significantly. In fact, there have been trading weeks recently where Bitcoin displayed lower volatility than major tech stocks like Nvidia. The narrative has shifted from high-risk speculation to digital gold. This change is largely attributed to the holder base. In the past, price action was driven by retail sentiment and leverage. Today, the ETFs are held by pension funds, endowments, and sovereign wealth funds. These entities rebalance portfolios quarterly. They do not typically panic sell based on social media trends. This institutional floor has dampened the wild swings we used to associate with the asset.
That stability is likely what made the regulators comfortable with expanding the menu. You mentioned Ethereum and Solana ETFs earlier. Are these functioning simply as price trackers, or are there structural differences in these new products?
There is a significant structural evolution occurring now. The first generation of ETFs were spot products. They just held the asset. The newer wave, particularly for Ethereum, includes staking ETFs. In the crypto ecosystem, assets like Ethereum can generate a yield through the proof of stake mechanism. The newer ETFs are designed to capture this yield, often ranging between 3 to 4% annually, and reflected in the net asset value of the fund. This transforms the asset from a non-yielding commodity like gold into a yield-bearing instrument, similar to a dividend stock. This feature is drawing attention from fixed income desks that previously had no mandate to look at crypto.
That turns it into a productive asset rather than just a store of value. Now, not everyone is comfortable sending money abroad or dealing with foreign brokers. For someone looking strictly at the domestic Indian landscape, what structures exist here in 2026?
The domestic Indian exchanges have adapted by creating basket products. You will see these marketed as coin sets or crypto SIPs. These are automated tools that allow users to buy a diversified portfolio, say the top 5 assets by market cap mechanically every month.
While these mimic the experience of an ETF by offering diversification and automation, legally they are distinct. When you buy a coin set, you're buying the underlying tokens directly in your name on the Indian exchange.
Which brings us back to the tax implications we discussed earlier.
Exactly. Because you're holding the underlying tokens directly, these domestic products attract the flat 30% tax on any profits. There is no concept of long-term holding benefits here. Even if you run a domestic SIP for 5 years, the exit is taxed at 30%, and you can't offset a loss in one coin against a gain in another within that same basket. The convenience of staying local comes with that specific fiscal liability.
That's a stark contrast. Looking ahead, we are just a few weeks away from the Union Budget in February 2026. The industry has been vocal about their demands. What is the realistic expectation regarding regulatory relief? The consensus among policy watchers is that a reduction in the headline 30% tax rate is unlikely. However, there is a strong expectation, or perhaps hope, regarding the tax deducted at source. Currently, the 1% TDS on every sell transaction drains liquidity from the market, especially for high-frequency traders. The industry has proposed reducing it to 0.01%, arguing that this would be sufficient for tracking purposes without killing volume. If the finance minister announces a TDS cut, we could see a revival in domestic trading volumes. But until that happens, the liquidity remains constrained.
We'll have to watch the budget speech closely. Another aspect of the ETF supercycle is the argument regarding safety. In the past, we saw exchange collapses and lost hard drives. How does the ETF structure alter the risk profile regarding custody?
The ETF structure effectively outsources the custody risk. When an investor buys a spot ETF, the custody of the actual digital assets is managed by regulated custodians such as Coinbase Custody or Fidelity Digital Assets. These custodians operate with institutional-grade security, insurance policies, and regular audits. For the end investor, this removes the private key risk. There is no seed phrase to lose, no hardware wallet to secure, and no risk of a personal phishing attack draining the funds. It converts a technical cybersecurity risk into a standard counterparty risk, which is regulated by US securities laws.
It essentially standardizes the risk to that of any other stock in a portfolio. Before we wrap up, I want to address some persistent confusion. We receive many questions that seem to mix up the rules. Let's clarify a few common myths circulating in January 2026.
It is important to clear these up, as misinformation can lead to compliance issues.
First myth: investing in crypto ETFs is illegal for Indians.
That is factually incorrect. Investing in foreign securities, including crypto ETFs, is fully legal under the Liberalized Remittance Scheme (LRS), as long as an individual adheres to the FEMA guidelines and stays within the limit of $250,000 per financial year. It is a permitted capital account transaction. The RBI restricts banks from processing payments for direct crypto exchanges abroad, but LRS for purchasing securities on stock exchanges is permitted.
Myth number 2. I can buy these US ETFs using UPI apps like PhonePe or Google Pay.
That is not possible. UPI is a domestic payment rail for Indian rupee transactions within the national banking system. US ETFs are denominated in dollars and trade on American exchanges. You cannot use UPI to directly settle a trade on the NYSE. The capital must move through the formal banking remittance channel SWIT network to a brokerage account. There is no direct UPI to ETF link.
And the final and perhaps most dangerous myth is, if I hold my crypto for long enough, it becomes tax-free.
This is a critical misunderstanding. Under the current Indian tax code for virtual digital assets, there is no holding period that makes the gains tax-free. Direct crypto profits are taxed at 30% regardless of whether you hold for 1 day or 10 years. The concept of long-term capital gains advantages currently applies only to the ETF structure because it is treated as a foreign security, not a VDA. Confusing these two rules can lead to a significant unexpected tax liability.
That distinction between the asset and the vehicle seems to be the theme of 2026. To summarize what we have covered, the market has shifted toward institutional products which are now available in variety. Access from India requires navigating the LRS route to capture potential tax efficiency, and while domestic options exist, they carry a heavier tax burden.
That is a fair summary. The market infrastructure has matured, offering investors choices between the convenience of domestic platforms and the structural efficiency of international ETFs. Each path has its own liquidity, compliance, and tax characteristics that must be weighed.
It's certainly a complex landscape, but having clarity on the rules helps in understanding the environment. We'll be tracking the budget announcements in February to see if any of these variables change. Thank you for walking us through the details today.
Happy to provide the analysis.
And thank you for watching. We hope this breakdown helps you understand the mechanics of the crypto ETF market as it stands in 2026. We'll see you in the next update. Disclaimer: this video is for informational purposes only and does not constitute financial advice. The market involves risk, so please conduct your own research before investing.